Okay. There you go. And we're on page 4. Okay, lapping. The accounts receivable clerk clerk. I don't know anything anymore. Um, oh, accounts receivable clerk. Accounts receivable clerk has access to the checks, then it is possible to conceal the theft of checks. Okay, let me clean this up a little bit. So if the accounts receivable clerk has access to the checks, then it's possible to conceal the theft of checks. And you'll notice that we talked about this before. This is if they have incompatible duties, or I think call them segregation duties. I'll call them incompatible. And the incompatible duties that the clerk has are record keeping. I think it's one word. And custody of the asset. Oops. So custody of the asset. So the checks are the asset. So this is when they have incompatible duties. What bad could happen? And sometimes, this comes about because people just don't understand why you'd keep those separate. They say, okay, we get the checks in and we'll just give them to the guy, or woman, whoever takes care of the accounts receivable. So they can match these checks up to the accounts receivable. It might seem like an ordinary thing to do, but actually it's a really bad idea. And here's why. So the accounts receivable clerk gets the checks and applies them to the accounts. And here's our people. Okay, unfortunately, the accounts receivable clerk is a compulsive gambler and steals a $5,000 check and goes to the racetrack, and clerk covers the missing $5,000 payments with other customer payments. Okay, so here's what happens. The first one, well, look at these dates. I gotta update this thing. 2021. Hey, that's when I was born. No, so this first one, they receives a check, or he or she receives a check, and it's made to the Bedrock Corporation, and that's fine. And it applies it to Fred's account, and that's fine too. This is a normal transaction. Okay, so this one's completely normal. Oops. This is what you expect. Okay, now, oops. Now we go to Wilma. Now, Wilma sends in a check and she writes it to cash. So the payee is cash. What's the problem with that? You write out a check and you write it to cash. That means anyone can take it and cash it.
It's untraceable.
Yeah, exactly. Yeah, and it's made out to cash. Anyone can cash it. Now we can look it up and see where it was deposited, but so Wilma writes this to cash. Maybe Wilma didn't know exactly what the name of the place was or whatever. So the accounts receivable clerk, who again, compulsive gambling. It's amazing how many how many embezzlements are because of people who are compulsive gamblers? The money just disappears. Okay, so whoever this accounts receivable clerk is, they take the money and they put it in their pocket and they go to the racetrack with the check. Okay, now the accounts payable clerk stole the check, but now they have a problem. What's the problem? What's the problem with taking the cash and not applying it to Wilma's account?
There's no credit on
Yeah,
for
Wilma's going to get her, a thing saying that you owe 5,000, and Wilma's going to say, no, 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 I sent it in a check. So now the accounts receivable clerk has to get to work. Okay, gets a check for $8,000 from Barney. Now we got to get Wilma off our back. So we are going to take, we don't need all 8,000, but we're going to take $5,000 of this check and what are you guys doing over there? So 5,000 of it's going to go to, let me highlight this and make it a color. So we're going to put 5,000 into Wilma's account. So now we got Wilma off her back. How much are we going to put in Barney's account? Yeah, the other was it 3,000? Yep. So the other 3,000 we are going to put in Barney's account. Okay, so it's not letting me copy it. Oh, copy. Okay. So we take the other 3,000 of the 8,000 and we put that into Barney's account. Now we got Barney on our back because Barney sent in a check for 8,000, but Barney only has 3,000 in the account. Okay, so now we got to get Barney off our back. Luckily, Betty comes along. And we'll make Betty green. Okay, so how much do we have to take out of Betty's check and give to Barney?
5,000.
Yep. Yeah. So now we got to make good on the 5,000. Okay. So now we got, okay. So we got 5,000. So now we got Barney off our back. Now we got to go and give the rest of this to Betty. So what is there? There's what is it, 1,000 left? Okay, so we got 1,000 left. So now we got, and now we still have Betty on our back here. But now here's the great thing about being an accounts receivable clerk. If Betty calls up, who are they probably going to give them to? Oh, here, talk to the accounts receivable clerk. Betty's going to be, talking to the same person that just took $5,000 of her check and gave it to somebody else. So you know, accounts receivable clerk will say probably something along the lines of, well, you know what, we updated the system and they zeroed out the accounts and now I'm putting them back in. You know, whenever we update the system, it happens. If it ever happens, wait a couple days and, you know, your account should be back up. They just keep doing it. People who do stuff like this, they never go on vacation. You know, they stay there. They have to. If they go on vacation, and by the way, a lot of times when they find stuff like this, it's because someone goes on vacation and, you know, all of a sudden someone says, well, where is all this? Okay. So this is when there's a breakdown of internal controls. This is when the record keeping person has custody of the assets. Large companies are not going to do this, but it could be, you know, small, medium-sized companies, they may. And two, medium-sized companies, companies when they grow from small to medium size, they often don't have their updated internal controls. They're running the same way they always did. You know, so even though they might be working in millions of dollars, they still hand the checks over to the accounts receivable clerk. You know, it's a very risky thing that they don't even know it because they're used to the simpler controls of when they were small. Okay, how would we find this? So you come in and do an audit. How would you find this going on? There are two of these four items here will actually help find it. Um,
A and C.
yeah, I'm busy messing up my, oh, there we go. Okay, I'm back. Yes, A, so compare the daily check total to the credits in the accounts receivable. Yeah, this would find, you know, this $5,000 check that was received. You look around and say, well, it's not in, you know, it's not in the in the account. You know, we received it. It's on the checklist, but we don't know where it is. It's not in there. So this one would certainly do that. C, yes, C, verify that the total amount of each check is entered in the accounts intact. This, it won't help with Wilma's check, but notice that for Barney's check, you know, you should see an $8,000 credit somewhere. And you look and you don't see an $8,000 credit, you go, okay, well, this should be entered intact. Why isn't it? And then you start looking and see, okay, it's going to two different accounts. And that would be a red flag, obviously, that there's lapping going on. So those are probably two of the best ways to find it. Comparing the daily check totals with the amount in the accounts receivable journal, seeing that every check is actually entered. And then secondly, making sure that they're entered intact. In other words, the total amount is applied to whoever's account that is. Lie detector tests don't really do anything. And bonding, do we talk about bonding? I think we did. Yeah, bonding helps this give background checks, but if this is somebody who doesn't have a record, it won't help. And it won't help actually finding lapping. This is more preventative if somebody committed a crime earlier. I mean, it's not a bad thing to have because of the background checks, but it's not going to help in identifying. And lie detector tests are almost worthless. Okay. Electronic funds transfer, we all know it. Yeah. Everyone has Yelp and all that kind of stuff. This is when you electronically move funds from your from one account to another. Um, Receive, I should say, or pay. account without a check. Again, back in the day, this was rocket science. It's no longer is, obviously. Everyone does it. Or a lot of people do anyways. Okay, year-end bank statement. Year-end bank statement is well, the year-end bank statement is sent to something here. It's sent to the client and to the auditors. And this is, I think we talked about this, didn't we? Do we talk about making evidence better? I can't remember. Hmm? I didn't. Okay. Uh, yeah, so the unit bank statement is sent to the client, obviously. So for instance, if this is IBM, IBM will get their bank statement. They probably have a bunch of bank statements, but also those are sent directly to the auditors. And this is a very common practice. So the cash is so important, and that it's a standard auditing procedure to have the year-end bank statements sent to the client, obviously, whoever owns the account gets a bank statement, but also it's sent directly to the auditors. Now, the auditors could take it from the client. So the client could get a bank statement, and from that bank statement, they do their bank reconciliation and all that kind of stuff. What's the problem with the client having the bank statement, though, from the auditor's standpoint? Bless you. So let's say the bank statement goes to whoever the client is, you know, um, Karen's laundromat. So Karen's laundromat gets their bank statement, and they do their bank reconciliation and all that. What's the problem with that bank statement, though, that when it's sent to Karen or whoever's running Karen's laundromat? As an auditor, when you come in, you're looking for evidence, and you get this bank statement that was sent to Karen.
Well, it lists all the transactions. If they were trying to hide anything, it would be there, would be visible. They would not be able to
Well, yeah, but they could alter the bank
can
statement.
alter them. That's where I was going that way, yeah.
Yeah,
The auditor collects like a confirmation from the bank, and then confirmation then to support the bank statement.
that's true too. And you'll also get they generally get the confirmations also sent to the auditors. There's a bank statement. There's also a thing called a bank confirmation, which I think is on there. It should be. If it's not, then I'm doing bad things. But so the bank statement is sent not only to the client, but also to the auditors, because again, if somebody has access to it, it's possible that they can alter it. Now, you want to make that into the best evidence you can. The best evidence comes directly from a third party. So this is why we have it sent directly to us. So this is evidence that is created by a third party. In this case, the third party is the bank. And is held by the third party. The client never gets a chance to hold on to this evidence. We get it directly from them. And again, this is a standard auditing thing. And when you talk to the client, you'll tell the client, you're going to tell your bank, you're going to authorize us to be sent directly your bank statement, also the bank confirmations and all that kind of stuff. Okay, a cutoff bank statement. We're actually going to do a case with this. But a cutoff bank statement is a very useful thing. A cutoff bank statement is sent directly to the auditors. And it is a bank statement is created usually between 7 and 14 days. Oops, that's not a 7. 7 and 14 days in the following period. So usually, like, if they have a year end of December 31st, then, somewhere in January 10th, for example. You'll get a bank statement, and the bank statement will be it's a regular bank statement, but it's only done 10 days into the next period, and we'll see why we do that in a minute here. It's basically to verify things on a bank reconciliation. The bank reconciliation is done to find the correct balance in the cash account. Oops. Oops. The 2000. What one? We're going to do one of these. Okay, bank reconciliation example. So a bank reconciliation, we start with a bank balance. The bank balance on January 31st is 2,400. So this. And the book balance is 1950, and obviously those are not the same number. Which one? And by the way, for you guys in the classroom, if you want to take pictures of the, I don't mind at all if you take pictures of the screen. I even know some teachers don't like that, but I would, you're absolutely fine to do that. This is also being recorded, so yeah. Okay. So we got our two balances. We got our book balance and our bank balance, and we're going to find out the correct balance of these two accounts, these two different groups, I should say. And for each side, we might add some things, we might subtract some things. And basically, what we're asking here is whose side is right? We got. Hey, how come it's not showing my typing? Let me go up here. Who is right? Who knows, there's gonna be some things that we know and some things the bank knows. And we're basically kind of say, okay, if, the bank knows something we don't, then we gotta adjust our books. If we know something the bank doesn't, then it's, we're gonna put it on the bank side and they have to adjust their book. Well, they're not gonna actually adjust their books, but they're going to, but it'll balance out in our bank reconciliation. Okay. So deposits in transit. These are deposits that are made at year end. So for instance, on January 31st, we go to make a deposit. Is the bank going to recognize that the same day? Probably not, especially if there's checks involved. They're probably not going to recognize it the same day. So we have these deposits in transit. For example, let's say it's on January 31st. Okay. So let's say on January 31st, we make we go and we January 32nd. No. January 31st, we make a deposit. The bank doesn't know. The bank doesn't have it on our bank statement. Now, we know we made the deposit on the 31st, but the bank doesn't. So whose side are we going to correct? Our side or the bank's? We have it on our books. January 31st, we made this deposit. The bank doesn't count it. Until maybe the next day or maybe in a few days later, depending on what it is. So whose side are we going to correct to find the correct
Our
balance?
side.
Actually, it's gonna be the bank. The bank just doesn't have it in there. We made a deposit, it'll be on in our book balance. We'll have a deposit of $515. The bank just doesn't have it. So we have to add this to the bank. So this will be our deposit in transit. And we're gonna add it in and say, wait a minute, we made this deposit of 515. Oops, that's not the right one. Hold on. 515. And we know we made it on the 31st. The bank just doesn't know or doesn't have it in there. So we are going to correct the bank side. Okay, EFT payments. These are electronic fund payments we talked about. Now, here's the thing. Are there going to be checks written for those? There's not going to be any checks written.
No, no, they're EFT payments.
And when are we going to find out about those usually?
In your bank statements.
Bank statement.
Usually they aren't deposited until you reconcile.
Yeah, so if you're online, you could probably look it up. But generally speaking, these are going to be included in the bank statement. You don't have a check, a check register that you're going to write this thing out. These are electronically done. Okay, so the EFT payment for rent, the bank knows it. We just don't have it on our books yet. So which side are we going to correct? Yeah, the books. So EFT payment, is that going to be a plus or a minus?
Minus.
Minus. Minus 120. And it looks like we got an EFT, we received payment from somebody, a receipt, so that's going to be a plus. That's right, there's an S there. Plus 50. I'm going to color coordinate these. We can kind of see them. Okay, so we did this one. Okay, we're down to NSF check. An NSF check, this is from a customer. This is not our check. This is from a customer. So customer gives us a check. We think it's good. We deposit it in the bank. We count it as a deposit. We add it into our cash. So we got this check. We think it's good. Maybe we check to see if it was good, and it was, but it comes back that it's NSF, not sufficient funds, and is not in our bank account. What's that? Yep, book side. So we'll have a NSF check. We have to take it out of our cash. We recorded it in our cash, but it actually isn't. We're not going to forget about it. We're probably going to try to collect it, but it does have to come out of our cash. Okay, outstanding checks. These are checks that we have written, maybe probably at month end. And we sent them out. We know we wrote the checks, but the bank doesn't. So, what's that? Bank, yeah, we know we wrote the checks, the bank just doesn't. So outstanding checks. Oops. 800 plus or minus? Minus. Ah. Okay, so we're done through outstanding checks. Bank fees. When are we probably going to learn about those? When you get, yeah, you get your
We
bank.
get a statement.
Yeah, so you get your bank statement, as we can probably, there's not going to be any check written. You're not going to write a check for that. They just take it right out of your account. So bank fees, 30. Oops. Pretty much anything that comes on the bank statement is going to go, is going to be part of our book corrections. That if we don't know about it. Okay, this one, I don't know how often this comes up, but it comes up a lot on the CPA exam if you're doing, or on bank recs if you're doing them somewhere. But note collection. So what is a note? A note is just like a check. So a note is like a check. If someone is, it's sort of like a post-dated check, and usually there's interest involved on it. So it's a little bit better than a post-dated check. There's interest involved. So someone will give you a note and they'll say, we'll pay you in 90 days at 10% interest or whatever it is. So note collection. Now, because it's like a check, it's not uncommon for people who deal in notes to give it to the bank to collect it because it's similar to a check. It's like a check. If you sign it, it means it's a non-demand. You must pay it. Whoever turns that in, you've signed it. Same thing with a note. You can't contest it. Whoever signs it, you have to pay that note. So it's very similar to a check in that respect. So having a bank collect it. Now, when are we going to learn about that they collected it? Yeah, probably the bank statement. So where are we going to put it? Yep. Book balance, we're going to put it in here, and it's a plus, right? They collected our note. So note collection. 500. Interest income. Where are we going to find out about that? Yeah, same way, bank statement. So, they'll have some little note on there saying how much interest we received. And in this case, it's $5. Now, Why I have so many accounts here? So many lines here, I mean. I'm gonna eliminate some of these lines just to kind of get on the same page here. Okay, so we'll end up with a corrected balance. And we'll end up with a corrected balance over here too. And they should be the same. They're the same. 2115. Both sides, I assume. So these two should be the same. They should equal. Now, on this side over here, you will make journal entries for each of those. You can't do it for the bank side. They don't let you. The bank doesn't let you go in and make changes. They're kind of jerks like that. But we would make these on our side. It would look like this. Oops. I'll do it on the board. So this is what this is what the journal entry would look like. Put my thing here and see what it. So the EFT receipt would be $50. I think they said that was for revenue. Let me see if so this would look like this. So our cash would go up. Asset up $50. And then we would have revenues. And revenues would also be going up. $50. I'm not gonna go through all of them, but you get the idea. So note collection. Cash 500. Notes receivable. 500. You'd make these journal entries for each one of those items on the bank reconciliation. You'd make these entries. And by the way, this is one of the reasons why they have to do it at the end, or else you don't know your cash amount in your cash account will not be correct. Unless they make these journal entries. So doing the bank reconciliation isn't just hey, it's something good we should do. You don't know your bank. Oops, that's not what I want. You won't know your bank balance unless you do a bank reconciliation. So this should be after we do all these, after we make journal entries for all these, then our book balance will be the 2,115. Sorry. Questions? I am going to skip the next bank reconciliations. We're going to skip these. These take a really long time. And these actually, one similar to these actually did appear on a CPA exam, but this is back in the day when I was taking it. And these would be like the 40-minute questions they'd have that they really don't have anymore. So we're going to skip these. And it's not bad to know, but literally it would cook the rest of the class just doing these two. So, and it's something you're probably not going to see anyways. So I should have not put those in, and I apologize for people printing these out. It made you waste 4 pages. Well, depending on how you printed them out, 4 pages. Okay, so we're going to skip these. The big bank reconciliations, we're going to skip these for now. Okay, but hey, that did that get cut off on the handout too? A big. Oh, it's just on mine. Okay, well, I'm glad it's on mine and not yours. That's odd though. Um, standard bank confirmation. Okay, the bank confirmation, what's on it? It'll have the ending account balances. It does not have all the transactions. If ending account balances for cash. It will have the ending balances for any loans. It will oftentimes have the loan agreement will be in there. Including cap collateral. It does not have daily, daily transactions are not in it. It's year end. What are the balances? What are the loan agreements? How much is left on, all those kind of things. And the loan agreements and the collateral are important ones because they'll give you information on what the company actually owns and what maybe they don't. Okay, so if you look at this one, this is if you look at loans, this is maybe a bad example. They don't show any loans, so there's no loans shown on this, but they do have two accounts. They have the general account that has 1,854,000, and they have a payroll account that has 5,000 in it. That's probably a zero account. So the bank is and all that kind of stuff. Okay. So which of the following can be verified from a standard bank confirmation? Ending balances? Yep. Two other ones. Yep. And the loan agreements are generally going to be on there. So you can see what the interest payments are, all that kind of stuff will be on that bank confirmation. They don't have the daily activities. This is year end only. So we're not going to see what activity happened in the first week or anything like that. Okay. Six. Which the following can be verified by wait, this got cut off. Hold on. Lost the line there. Cut off bank statement. We will actually go through this. Deposits in transit we'll be able to find verify those. Unrecorded liabilities. It's possible we'll find kiting. So it's possible we have all of these, but it's also possible we don't find kiting. But generally, it's possible to find all of these, I guess, on there. And we are going to do one next. Which time do we have? All right. Yeah, well, let's do this one. This is a cutoff bank statement that we will, yeah. It's from 2021. So let's go through this. So the corporation pays employees on the 28th day of each month. The last payroll of the year was on 12/28/21. For control purposes, the account is funded for the exact amount of the payroll on the 28th of each month. That's a good thing to have, is a payroll that the exact amount is funded, because that way, if somebody writes additional checks or steals checks and writes them to themselves, it will show up, the account will go red. It'll go, there'll be more taken out of it than actually was in it, and that will be a red flag that there's a problem, and then you can start looking for it. So this is a good control to have, and most places will have that. And actually, if you look at this bank statement up here with the payroll, this one, it says there's 5,000 in it. That's probably like the 5,000 that's always in that account. And if it goes below 5,000, then they know there's a problem. Okay. So the bank reconciliation had the following outstanding checks. So these are the checks that were identified in the bank reconciliation. Before you even go through this, there might be a problem with the controls. What is it? Looking at the outstanding checks. Which one? There's something odd about what we have up above here and the payroll. Yeah. This indicates that what they told us that is paid on the 28th of each month apparently isn't set in stone, because here we have one that was written on the 14th. Now we would probably have to look and see why it was written on the 14th, but there actually is one that, from what we were told, shouldn't be there. Okay, well, let's go to the cutoff bank statement. So 8 days into the next period, we get this cutoff bank statement. So what we're going to do is match up the ones that have cleared with those that are in the bank reconciliation. Okay, so this one on the 14th, it did clear. We will mark that in green. How about? So here it is. So all we're going to do is kind of go down the list here and see which one's cleared. So this one, I'm going to put, what is it? 170133. Okay, and they are clearing for the same amounts, it looks like, so that's a good sign. Okay, so this is what we're left with. Now, check 17,894 still didn't clear. Maybe, whoever got the check didn't cash it yet or whatever. And it's not that every one of these has to clear by the cutoff bank statement. There might be people that I worked with a lady who was independently wealthy. But she was teaching as kind of a hobby, and they had to keep telling her that she had to come pick up her checks because she'd never she went to pick up her check for like 6 months. She came from a very wealthy family and it didn't matter too much to her. So the rest of us were not like that. But anyway, there is something very concerning here, though. What is it? Yes, these down here are a real problem. If they cleared in the following month, that means that, they had to be written sometime before that, obviously, and they weren't on the outstanding checklist. And they're telling us that they only write the checks on the 28th of the month. So the question is, where did these checks come from and why weren't they on the outstanding checks? So this is actually a problem, and we definitely had to look in to see why these were written and whether they belong in the previous period, because this might be understating expenses that, I don't know whether these were bonus checks or whatever they were, that these are checks that were obviously written not on the 28th, but they're not on the outstanding checklist either. If they hadn't cleared, they should have been on the outstanding checklist if they were written on the 28th, but they weren't there. So the question becomes, what are they and how do they get there? So this is a problem with cash, and on something like this, there might be rational reasons why there was a check on the 14th. There might be rational reasons why these ones are written early in January if they were. But that's something you have to look into. And it's certainly, you would definitely look at this and say, okay, there is a somewhat of a problem on the controls, and that these are not just written at the 20th day of each month. We know that from the 14th, and we know that, well, possibly from those ones that were written later. But this may be an attempt to understate the expenses. Question on that? Oh, what concerns are about the bank? Oh, I just said it. I should have written this out. Okay. Uh, so the concerns are, I'm just gonna do kind of a listy thing here. One, uh, the checks were being written only on the 28th of each month is obviously not being adhered to. And we know that from the one on the 14th, but possibly these other ones too. And second of all, hey, I lost my second. Oh, what do I have in here? That the check's not on the outstanding checklist. Be an understatement. So it may be understating their expenses by not including those on that outstanding checklist. So yeah, and either the checks, even if they were written in January 1st, so if they did write them on January 1st, okay, let's say they're not adhering to it. The question is why they were on January 1st, and how could somebody earn, whatever, $3,000 in one day? These were probably due to some service that was done before January 1st, I would assume. So even if they weren't written till the following January, early, the first day of January or whatever, it does raise a question of, even if that was the truth, that it would, why weren't they? They probably are for service that was done before January 1st. So even if they're saying, well, we do write sometimes, not on the 28th, that's fine, but whatever those dollar amounts could very well be from other. Okay. Let's stop here and take a break. And let's say be back at 7:15. Oops. And I am going to, when we come back, we'll start up with the classical sampling. And we should at least get the first one done, and you guys can take off after that. Okay, so let's see. The next thing we're going to show, let me put up the so this will be the next thing we cover for those of you playing along at home. The zoomies. Oops. Okay, so we're gonna stop here. Let's say be back at 7:15. Uh-huh. Okay. Huh? Yeah, this one didn't clear. Well, it could be that it's going to clear later on. If it goes more than a month, sometimes you might remind somebody that they need to deposit it or see what happens to it. Maybe they lost the check. It's possible that someone stole it or whatever, but you would think that they stole it, they would have cashed it. But yeah, you may have to do some searching to see why that what did clear. But again, it's only been well, it's probably been what, 31st, it's been like 11 days. You might check and see what the story is on it. But and certainly if it goes into the next month, they would have a follow-up to it. Probably not a concern. And again, especially if they're dealing with a lot of checks, you're gonna have stuff like that. Someone leaves the check and they go to Spain or something and they don't cash it. Huh? Kiting?
Oh, it's on the next week.
Oh.
Yeah. I mean, that was in the multiple choice questions, like the option was there. But I was, it was not that.
Oh, it's again, we already did that. I don't know. Yeah, I'll look at that one. Oh, yeah. Kiting, yes. Yeah, that doesn't happen as much anymore. It's when they used to use two banks and they would make use of the float. Well, we'll talk about it, but so for instance, if I write a check, you give it to the bank, the one bank immediately knows you're depositing the check. It won't clear the next bank for a couple days. So you can make it look like you have more cash than you actually have. You write the check, don't record it. It goes into one bank, you have two bank accounts. They have a $10,000 check in the one and you don't record it. It looks like you have a magic $10,000 that showed up. Doesn't happen as much anymore, but yeah.
Last week I was on Zoom. I don't know if we take that attendance for last week.
I think I did, yeah, let me stop sharing. Oh, you know what? I don't have, I don't have my USB that I was supposed to have it. But here, let me check and see on, I'll get the Blackboard, see what they have. Oh, wait a minute. Hopefully it will still allow me to get. What's your name?
Hi, Josh.
Wait, this isn't where it's going to be. the attendance will be here. Are you kidding? It should be making me sign in again. Yes, it is. Yeah, classical sampling. Okay, so- Yeah, okay. You know me. Oh, we need one more, I think. No, three. Okay, let's see, let's take a look at the agenda. No, I don't want this. What am I doing here? Oh,
Notarized the first time.
was you? Yeah, I got you last week. Well, thank you. Yeah, but other than get you guys in this week, but. Yeah, I'll take a chance with it. Okay, let's come back into the, what's your name? And those three, there you go. Okay. No, just the classical sampling. Kick me out of here, I know, so close them up. I'll leave it. I'm sorry. I should have turned off my camera. I forgot. It's time to get back, huh? I filled it out and I submitted it. Yeah, I didn't, you had another teacher on there. I didn't see that they did that yet, but I filled it out today.
So.
Yeah. Oh, yeah. Yeah, good. Okay. Yeah, let's, I'm back. 30 seconds later, I'm back. Okay, okay, actually, I'm gonna go to the board here for a minute. And just kind of go over what sampling is and why we do it in a auditing. Sampling is when you take you have an entire population. And what you do is you take a sample, a small group of it, and you run your test on that small group, the small sample. And the idea is that whatever you come up with that group, the small group, you say, okay, we ran on this group and we know that has these characteristics, and we will project it over the entire population. So okay, it could be for anything. It could be for medicine or whatever. Okay, we have a medicine that we want to try using. We can't. The entire population is 8 billion people. We can't do it on everybody. But what we'll do is we'll take a small sample, 100 people, 200 people, whatever it is, run the medicine on it and say, okay, if it works in 38% of these people, then it probably works on 38% of the entire population. If you get a large enough, we get a sample that will be representative of the total population. So it could be, for anything like that. Now, for what we do, it's for accounts usually. So the total population might be sales. And what we can do is take a small sample of sales. Now, maybe we take 100 of these and we can project it over the whole 23,428 of those. Okay, we got 100 of them, and we will say, okay, these are misstated by a certain amount. We're going to project it over the population as a whole. So this is the idea behind sampling. You take a small sample and you project it over the whole. Now, you say, well, why don't you just test all of them? Well, that would take a really long time. And a lot of times with a fairly small sample, you can get fairly comfortable with that it represents the population as a whole. If you're auditing to say the 95% level or something like that, usually a small sample can usually, a lot of times can get you there where you can be 95% sure that you get estimate for the population as a whole. And there's some things that you simply can't do. For instance, if you were to try to look at all of the merchandise inventory for Walmart, there's not enough auditors in the world to do that. You have to take a sample. So anyway, that's what we're doing in this case. And this is sort of the way you're going to see it. Usually the classical sampling done on the CPA exam, they have multiple choice questions. They might have a little bit of a testlet thing, but for the most part, a lot of times you see this with multiple choice questions. Okay, so here's our book value. $1 million. And we have 25,000 sales. That's the population. So if we were to, this is what this would look like. These are the sales, the book value would be $1 million. I forgot. Sorry. 1 million. Okay, so this would be $1 million. And the population will be for 1,000. So 1,000 sales. That's our dollar sign. Oops. So that would be what we'd be looking at for this case. And oh no, I'm sorry. It was 25,000. But we're going to take a sample size of 1,000 and try to project it over the total of it. So we're not going to take all 25,000. That would take a lot of time and probably waste a lot of time. So we get the sample size of 1,000. And we do an audit, and the audit says that those 1,000 are worth $37,800. The book value of that same sample says it's worth 42,000. So we came up with 37,800. The total book value is 42,000. for the same sample. So how do we calculate the audit average? Let's take this one first. How would you figure it out?
So
So-
37,800 divided by 1,000, the
Yep.
simple size, yeah.
And so that comes out to, what is that, $37.80? $37.80. So this will be our audit value. And by the way, this is the one that we'll put the most, this is the one that's most persuasive, because this is the one that we calculated. We put more, we put more reliance on this one because it is what we did, not what someone handed us, which is what the book value is. Okay, the book value is divided by 1,000. Oops, the average book value is $42. Okay, so the audit average is $37.80. The average book value of the sample is $42. And now we are ready to do this. So we got our averages. Now we have to spread it over the entire population. And there's three different ways we're going to do it. We're going to project it over the entire population, but they're going to do it three different ways. And the first one is the mean per unit. And I have the formula here. By the way, the formulas are also at the end of this thing, I believe. Yeah, the formulas are at the end too, if you want to take a look at them. Okay. So, mean per unit. We're going to take the audit average. Let me highlight this. So the audit average is 3780. And what we're going to do is say, okay, everything in my spacing got goofed up here. Everything in that the total population, all 25,000 of these, should be valued at what we come up with is 3780. This should be what the total projected value is. Look at that. So 3780. What was it? Really? Well, you're right. Yeah, that's not, no, you're right. It seems like too clean of a number for the 3780, but yeah, you're right. I must have been paying attention when I did this one. So yeah, so this will be our projected value for it. So for the mean per unit, what we're saying is, okay, this is, it's not worth this, it's 945,000. That's what our mean per unit when we project it is saying. So it's misstated. according to our sample. And now we go into how much is it misstated by? Yep. Okay, so we will take the total book value is this. I ran out of colors for it. We'll make it gray. So total book value, which is gray, minus, excuse me, our projected value, which is the 945. Equals our projected misstatement, which is 55,000. So what we're saying is that this is, the projected value is 945. The misstatement is 55,000. And the question is that an overstatement or an understatement? Yes. Because it's a positive number, it's gonna be an overstatement, so we're at this point here. So we're saying they're overstated by 55,000. We say their account should be 945 and that they're overstating it by 55,000. If you guys gotta go, feel free. And this will be in the video. Make sure I got you guys. Okay, let's see, Kelsey. And Shetty. Okay. Who's that? Conrad? I don't hear you. Oh, I'm sorry. No, Conrad's not here. Okay. I've actually got you checked in, but I will, I'll take a look at it next week. Okay. Oh, you got the first part to the right. I get it. Okay. Let me put that in. Okay. Okay, so this is the, so that's the mean per unit. Let's go to the ratio estimation. And the ratio estimation is that we have our audit average times the book value equals, scratch that. It's the ratio of audit over book. This says that everything is off by a certain ratio. That when we have our let's see, our averages, that there's a ratio between the audits and the book values that the whole thing is off by. So I think I'm going to put it in here, I guess. So this is, let's see, our audit average is 3780. And our times our book value, which is million. And this will get our projected value. 900,000 even? Really? I must have been paying attention when I did this one. No, just look at the numbers, it doesn't, yeah, I guess it's not obvious, but yeah, that's it. So this is 900,000. Yep, so this is. Okay, so our book value is the same million. Oops. Minus 900,000. So 100,000. Okay, so let me highlight all this. So we're saying the projected misstatement is 100,000. So the projected value is a million, the projected misstatement is 100,000. Overstatement or understatement? Overstatement. We're saying that they're overstating it by 100,000. Oops. All right. Difference estimation. Difference estimation is sort of different than the ratio. The ratio estimation is that, large accounts are off by large amounts, small accounts are off by small amounts. Difference estimation is where everything is off by the same amount. It's likely that it'll be off by the same amount. And for instance, maybe they don't charge a handling charge. Maybe there's a handling charge that gets left off the invoice. It's for the same amount. Let's say it's $25 an order. It gets left off. That means that a big account might be off by $25. A small account might be off by $25. Okay, so we take the book average minus the audit average. The book average is 42. Oop, zeros. Minus audit average is 37.8. And I'm going to close those up in parentheses. Okay, so 42, that's the book average. Minus the 37. And so this is the difference between those two. And we're going to say everything in the population is off by this exact difference, whatever it was, whatever it is. So 30, what is that? 42 minus 38 or whatever. 4.2. Okay, so everything's off by $4.20. We're going to multiply that by 25,000. Type this in here just so we know what. What was it? 105. So this is the projected misstatement. Now this is where it gets a little bit tricky because notice that this is the misstatement. The other ones we did the projected value first. This is the projected misstatement. Okay, so we're saying is this. Now it is positive. So this is going to be an overstatement. Yes. So we have to solve for the projected value. So the total book value is 1 million. Oops. Whoa. That again. So 1 million minus, we don't know. Let's put X here. Equals positive 105,000. Okay, and yeah, solving that for X. Probably the easiest way to do it is be add X to each side and then divide by subtract 100 million from it. But you're gonna end up with X equal 895. Yep, very good. Yeah, I'm gonna do that on the board just for kicks. So solving that for X would look like this. So 1 million minus X equals 105. So add X to each side. 1 million equals 105,000 plus X. Subtract 105 from each side. Okay. You guys probably know that. But I just wanted to just show you that. Actually, looking at the board, it looks even more like a mess. But anyway, this is the I tell you what, I'm going to give you the number 2, but let's do this as homework. Let's do this as homework. I know it's Halloween and people are out trick or treating and all kinds of stuff here. There's other holidays going on. So let's say let's make this homework and I'll check it in next class. And we'll go over it next class. But do this for next class. Do this as homework, the second one. And again, it's gonna be the same as this, obviously. And again, this is probably the more modern way you're gonna see the sampling done on the CPA exam. And this would probably be what they would probably end up doing is they'd give you this information up top, and then they'll say, what is the projected value using ratio estimation? That would be the how they would show this. Okay. Any questions? Okay, so we'll say this is homework for next class, and we'll go over it, and then by next class we'll certainly finish up the chapter 10 handout for cash. Have the practice, have some multiple choice questions, and then we'll start in on chapter 11. But any questions? I know it's a little early, but a lot of stuff going on tonight. There's also is it an Indian holiday?
Yeah.
Yeah. So there is an Indian holiday, and it's Halloween, and it's yeah. The world is telling us that's enough. So, any questions? Okay, well, I will see you guys next week.